Welcome back to Beyond Four Walls, Conversations on Affordable Housing. I'm David Dworkin, President and CEO of the National Housing Conference, the nation's oldest and broadest affordable housing coalition. I'm joined today by Laura Escobar, President of Lennar Mortgage, the lending arm of the nation's largest homebuilder, Lennar Corporation. With more than 37 years of experience in mortgage banking, Laura has led at every level, from branch management to executive leadership, in both bank-owned and independent mortgage companies. Since joining Lennar in 2002, she has risen through the ranks, becoming president in 2018, and now leads a team of over 1,700 associates across 57 branches in 30 states. But Laura's impact stretches far beyond corporate leadership. She's a passionate advocate for paying it forward, investing her time and energy into causes that support women, minorities, and underserved communities. As the 2025 chair of the Mortgage Bankers Association, Laura is helping shape the future of housing finance with a fierce commitment to excellence, equity, and empowerment. Welcome, Laura. I'm so excited to talk with you today.
As am I. This is really exciting. Let's get started. What do you want to know?
Well, there's a lot going on, but let me ask my standard question so people get a chance to know you a little bit. What's the most interesting and important fact about you that has nothing to do with your work?
Well, I don't know that it has nothing to do with my work because I use it all the time. I am a licensed mental health counselor. I started down that path before I even thought I'd end up in mortgage banking. But as we all did, I started working in the mortgage industry to help pay for school. And like we all did, I drank the Kool-Aid and got sucked in. So even though I'm not practicing in the traditional sense, those skills have stayed with me and I use them every single day.
Oh, I bet you do.
Oh, yeah. Listening is probably one of the most important skills that I learned as a therapist that I'm employing, not just in work, but in my complete life as a mom, as a wife, listening, staying calm when emotions are running high. So knowing when someone just needs space to talk, it's helped me be a better leader, a better parent, a better human.
Tell me more about that.
Well, I've had just so many opportunities to lead women groups, to lead dysfunctional families. I specialized originally in chemical dependency.
Oh.
And did a lot of groups for the state of Florida. So I do often when I have an opportunity, not this year because MBA has kept me really busy. I've often come back and say, okay, I can take one group this Saturday and I'll do the DUIs for this Saturday, just to stay connected in what's going on in our community.
That's great. It's such important work. And I was actually just in San Francisco and in Los Angeles and in LA. We went around with a team from Keck Medical School's street medicine program, and they were treating homeless people on the sidewalks. And it was really incredible. And, you hear a lot about drug addiction and about treatments and how do we, address the problem where it's at. And this stuff is so important on so many levels. And I think we all know people who've struggled with this.
You have no idea what we come across. I tried for the longest time to go into specific group sets to say, okay, we're going to just deal with executive women. We're going to just deal with first-time children that are having challenges with chemical dependency. But every time we turned around, it was bigger, bigger, and bigger than we were. So at this point, there is no isolation. It's who needs the help. To your point, it's everywhere, David.
Yeah, it really is. And it comes up in so many ways in all of our work. The communication, getting back to your earlier point, is so important. And it's one of the things that has been so missing from government generally, Congress in particular, but also our national discourse. And the ability to just hear people where they're at is so important. And what I think has been one of the most encouraging things I've seen in a long time is the Senate's Road to Housing bill that Senator Scott drafted, and then Senator Warren stepped up and said, hey, let's work together on this. We can make this work. And the two of them listened to each other. They compromised. They didn't agree on everything. They didn't have to. There was plenty there for both of them to say, here's a package we can both get behind. And it was really refreshing to see that and to see it pass almost unanimously in the Senate Banking Committee.
Completely agree. Big picture, I think the bill is an encouraging sign that Washington is really, they're paying attention to our housing challenges. And MBA supports it because it's designed to make housing more affordable and accessible, not just in big cities, but in the areas that really need it, the rural communities across the country.
Yeah, I mean, every community has a unique set of issues. There are many common denominators, but the idea that it's about location, location, location is true in so many different ways. And one of the things I really liked about Road to Housing is that they try to address it as a continuum. One of the things that I think is the most interesting for me is taking on the issue of small dollar mortgages. And that's where, we always think about houses that are too expensive, but there are also homes that are much less expensive that are hard to mortgage. They're hard to rehab. They're hard to build often, and because of the fixed costs. So tell me a little bit on the mortgage side, and on the home building side. Why is it harder to make affordable homes and to do mortgages that are less than, say, $200,000 or even $100,000?
Well, I'll go back to what you just said. Fixed costs. It can be so difficult to make the numbers work when it comes to serving these borrowers, especially in the rural areas. And it all comes down to fixed costs. While MBA will support the proposal to require CFPB and FHFA to evaluate the impact of existing regulations that limit the points and fees that we can charge on qualified loans. I mean, until we do that, this is going to continue to be a problem.
Yeah, I mean, there was a lot of abuse of points and fees in the run-up to the mortgage crisis, but the regulations just stretched so far over the edge. And what we ended up having is just making it impossible to do these mortgages at all. And as you know, we're talking about most of these fees are around 1% of the mortgage amount. And if it's a smaller mortgage, it becomes pretty much a disincentive for lenders to do it or their ability to do it.
I do want to make one point. The fact that the Senate Banking Committee, and you said it earlier, signed off on this on such a strong bipartisan support, that is so very rare that we see that coming out. And it gives me hope that we can keep that cooperation going to expand supply, improve affordability, and strengthen our housing programs. But one piece that's especially important is breaking through the log jam of zoning and land use. We have so many dysfunctional local, state, and national policies that it makes it so hard to build. The bill directs HUD to create best practices frameworks so communities can identify, they can overcome those barriers, and I think that's huge.
Yeah, we really need to help communities get over the zoning issues. They need to rationalize them among different communities that are in similar geographies. And the NIMBYism has been a real problem, but I think as home prices have gone up, more and more local officials have realized that it's just not sustainable, that they've got to make the changes necessary to build more housing and to have higher density housing.
That's exactly right.
So one of the things that, we often talk about is the importance of growing the market. And MBA has remained committed to the Black Homeownership Collaborative that we work on directly, and also its Convergence initiative.
Yes.
And I really appreciate that. And tell me a little more about, how you see the broader commitment to what is really about market expansion, as well as fairness and equity. And the Convergence initiative in particular, which I think is a really fascinating involvement for the organization, yeah?
Yeah, very excited about Convergence. It is going incredibly well. For listeners who might be unfamiliar through what Convergence Initiative is, the MBA is working with diverse groups of stakeholders to expand homeownership opportunities for all and narrow the racial homeownership gap, right? So working directly with a wide range of groups within individual communities, we find creative ways to bring more housing supply and find new approaches to expanding affordability. We've implemented convergence strategies in Philadelphia, Columbus, and Memphis. And I'm really, really excited to share that Baltimore, Maryland, has been selected as the next convergence city. While we're still months away from the official launch, the work has already started to recruit partners and develop a strategic plan. So after demonstrating that promise, the promise of convergence, MBA joined with other industry partners to scale the effort through Convergence Collaborative. It's a new independent 501c3 entity. And over the next 3 years, the collaborative will deploy more than $1 million a year to expand the impact of convergence. So the funds will be used to support the launch of new convergence cities and replicate what we've learned and what successful programs across the network look like and beyond. So I'm really, really excited about it.
That's awesome. And we were in Memphis, Tennessee, a little over a year ago, celebrating the anniversary of the Black Homeownership Collaborative. And as you know, Memphis is a convergence site, and we got to see a lot of the work y'all are doing there. And it's pretty impressive. And I'm looking forward to learning more about what's happening in Philadelphia and some of the other cities, because there's an element of this, and I think you know this, that as you continue to learn, you're able to plug those experiences back into your work and really scale and leverage it.
Well, you learned in the first few, and then after that, it's absolutely scalable.
Mm-hmm. One of the issues that we struggle a lot with when we talk about expanding markets is credit scoring. There's several issues with that, and it's always important, I think, to keep in mind that the value of having accurate credit scores is essential to being able to make sustainable mortgages. I think part of the problems that we've addressed is that when we get outside of the traditional credit profile, these models don't do a good job. And tell me a little bit about that, because as a lender, you're really seeing how credit scores are impacting especially first-time home buyers all over the country.
Yeah. Well, I'll bring to light what we all know at this point, but for our listeners' benefit, FHFA recently announced the rollout of the alternative credit scores, right? We are thrilled. It's huge. It's a historic move for our industry. It's not just a change, David, in score models. It's an opportunity to modernize the way we evaluate creditworthiness. We've been talking about innovation in this space for so long, and now we're finally seeing something take shape, right? So for that, I have to thank Director Pulte. And what's especially exciting is the opportunity to introduce more advanced, forward-looking tools into our mortgage process. And it reflects real progress in assessing the consumer's behavior. More data, for the most part, is better when it comes to assessing a borrower's financial situation and their ability to repay. So we share FHFA's goal of building a more efficient, transparent, competitive credit scoring system, because we need to be there for as many Americans as possible.
Yeah, and as you know, Director Bill Pulte at the Federal Housing Finance Agency, he has been very passionate about this. And we've been talking about it for a long time. And it's so helpful to have a regulator saying, you know, you've been talking about this for a long time. Let's talk about what you're doing, and really pushed, I think, everybody to move forward here. So tell me a little bit about what that means for the borrower. How's the borrower going to experience this?
Well, it's huge. It has potential to score borrowers earlier in their financial journey, which is incredibly important. We're really hopeful that it'll expand access to homeownership, especially for people who've historically been left behind by traditional models. If implemented well, this could be a game changer for housing.
How so?
Well, as with any major initiative, there's lots and lots of work. But we need buy-in. We need an alignment across all data holders, loan originators, the GSEs, mortgage insurers, and of course, investors. The agencies need to fully analyze how these new models will affect credit risk, pricing, policy, and then determine if adjustments are needed. But we also need to ensure that these new models truly assess risk in the best way possible. Mm-hmm. The goal is to use the most predictive model, not just a different one, and to make sure that it works in every real-world scalable environment. Does that make sense?
It makes a lot of sense. And what we're looking at is actual credit performance, and then trying to weigh how that's going to impact your ability to make your mortgage payments on time. And we want that to be as accurate as possible.
Yeah.
And a lot of us basically interact with various forms of credit in similar ways, but others have different credit profiles, and it's harder to put it in the same box. But in reality, they may be just as creditworthy or even more so. And predicting that accurately, it means you got to lean into new models and new algorithms.
Try new things. And
Yeah.
this is a good thing. But I also want to mention to our listeners that MBA has been studying ways to reduce costs for our consumers while maintaining our sound underwriting standards, including moving the current tri-merge credit report requirement to potentially a single or bi-merge model for GSE and government loans.
Mm-hmm. And that means 3 different reports that are put together as opposed to one. Tell me a little bit, why do we have 3 reports in the first place?
It's the way it's always been. You ask everybody that for years and years and years because that's the way it's always been. And that's what we've got to start. And this administration is definitely doing it. They're challenging that status quo.
Yeah.
We had our RESBOG, the Residential Board of Governors at MBA, recently passed a resolution urging FHFA to adopt this change. It could foster bureau competition, David. It could improve accuracy, but at the end of the day, lower cost, which is really what our responsibility is to our consumer.
Yeah. And there's a lot of technology behind the scenes that has to be integrated into making this change. It's not just flipping a button or flipping a switch.
There are multiple challenges with technology. First, we need investor acceptance for MBS. Mortgage insurers also need to remodel their risk assessment strategies to work with these scores. All of our software, all of our vendor partners need to be fully prepared to integrate and support these new models. Another big challenge is managing multiple systems, scoring systems. We'll likely need to support both in the beginning, right? For a while, especially for government loans. So that's going to require system updates, careful coordination. It's definitely a game changer.
Well, and one of the things that's been the case for a long time is the concern that if you're too transparent about it, people will game the system and adjust their, I guess, credit behavior to get a higher score. I thought that was kind of the point, right? That we make changes in how we interact with credit, get a better score. I've always been puzzled by that one.
Yeah. Well, I will say on the gaming component of it, we need to establish really clear rules on how the scores are going to be pulled and used to prevent score shopping or gaming the system. But it's a natural consideration when there are multiple models, right? We need proper controls, and the industry can handle this responsibly.
Yeah, I think that's exactly right. Tell me a little bit about the homeowner insurance crisis. We've been increasingly involved in that. I know you've been experiencing it at a policy level, but really firsthand all over the country. Give me just a general sense to start of what's going on with residential property insurance and in costs, and what are you all seeing in terms of the mortgage business?
Well, it's become a real pain point for borrowers. Many of them are so confused, overwhelmed when they try to secure insurance now, especially in states where the carriers have either pulled out, which we have experienced right before closing, or significantly raised premiums. We're seeing last-minute changes that can derail closing timelines or, worse, David, affect affordability. For buyers who are already stretched, this can be a tipping point. We all know affordability is becoming a major issue. I recently saw a statistic that since 2020, the average home insurance premium has increased by 61%. Since last year, it's gone up 9% alone.
That's really shocking.
It's shocking. And at the same time, the average policy coverage has gone up 35%. So we're paying more and getting less protection. That's a problem.
And a lot of people always thought, well, I have a fixed rate mortgage. My payment's going to be the same. And it's true, your principal and interest payment's going to be the same. But people are getting hit really hard on the taxes and insurance. And in some cases, it's presenting really systemic challenges.
Yeah, it's impacting the monthly payment. A quote from the National Mortgage News stuck with me. They said, homeowners are dedicating a larger portion of their monthly mortgage payments to insurance, with some borrowers reporting that over half of their payments now go to taxes and insurance.
That's shocking.
Think about it. It's a huge shift in the affordability conversation, and it's creating real pain points for homeowners and borrowers everywhere. And a recent report by Cotality concluded that serious mortgage delinquencies are growing, and it's putting a lot of pressure on the states, especially those that are particularly vulnerable to what? Natural disasters. It's really becoming a hindrance. What solution do they come up with all of this climate change and everything that we're experiencing? It's not just Florida and California anymore. Insurers are facing tough choices and homeowners are feeling the squeeze.
We're having catastrophic weather events all over the country and much more frequently. And I think one of the most dramatic examples is what happened in Asheville, North Carolina. I mean,
Yes.
the uninsured losses there are multiples higher than the insured losses because who plans for a hurricane to, have flooding damage at 1,200 feet above sea level?
Oh, it's devastating. What we're seeing is devastating. Natural disasters, couple it with inflation, reinsurance pressures. It's absolutely out of control. But I'll tell you something, there's an opportunity in this challenge. It's opening up conversations, David, about how we build homes differently. We've seen in the news, you've seen that we are building the 3D printed homes. We did a whole community in Austin, Texas.
Mm-hmm.
We explored and built a smaller footprint home that we call the micro homes in Texas. And we're using geothermal technologies in Colorado. We're working with Vive in California on innovative building methods. It's pushing us to think creatively. How do we build more resilient, sustainable, and affordable homes in the future? And it's not just new homes, it's retrofitted as well. How do we get that mindset to say, okay, enough about the insurance. Let's see what the solutions are and move forward with that space.
Yeah. How you design the roofs even has a huge impact. And last week I was in Altadena, California. And as you know, the Eden Fire wiped out 9,000 homes in Altadena. It was really breathtaking to drive past lot after lot after lot. But then you'll come across a home in the middle of really where a firestorm wiped everything out. And it's still there. It's pretty incredible. And the reason is because the embers couldn't get into the house. The roof wasn't flammable. And when the firestorm goes through, they were miraculously saved. There weren't a lot, but it just shows that when you build it right, and we redefined what right is, you can make a difference.
I'll tell you, we need to explore more flexible coverage options. We need alternative models. We need creative deductibles that allow for better balance between risk and protection, right? But it's not just about insurance. I have to keep going back to it. We also have to take a look at the homes themselves. And it's a big part of the long-term solution.
And Lennar's doing a lot in that space in terms of new home building technologies.
Yep. We're constantly, like I said earlier, all the things that we're doing, we're constantly dipping our toe. And that's one of the things that I'm so proud to work for a company, that it's not just about building homes, one in track after the other, after the other. It's not just about financing. It's about tomorrow's homeowner and what that looks like and what we have to build to serve that homeowner in the future.
And tell me, what are lenders doing to help people get insurance and deal with the crisis that we have right now?
Yeah. Well, first, we're educating buyers. It is critical that we educate the buyers up front. A lot of them, like I said earlier, they don't realize. They think because they've received a quote, good to go, ready to go until closing. We've got a lot of surprises. They're not bound until they're bound. If you wait too long or you don't understand the process, you're going to get hit with a higher premium or a last-minute surprise. And it has happened to us time and time again. So what did we have to do? Guide them, support them. It all starts with the loan officer. It's setting up that expectation of this is what you need to do. And let me tell you what's going on across the country if you haven't seen the news. But at the end of the day, the borrower, the home borrower, is responsible for obtaining homeowners insurance, getting it bound and making sure it's in place before closing. But it's our responsibility to make them aware and educate them.
And communication is so critical. We just keep coming back to that over and over again in this conversation and in life. But if somebody comes to a closing table and they know that this is an issue and they've tried to prepare for it so that it doesn't become one, or at least they're aware, then the credibility of the loan officer is actually enhanced. But if people get hit with something sideways at that closing table, it feels like everybody there is against them. And that's not the dynamic that we want.
And adding insult to injury, David, is when you either refer or you are one of our companies is our insurance partner. Who are they going to come back and blame? They're not going to look at the insurance company. They're going to all come back to who was it that told me about this insurance company. And at the end of the day, it becomes the worst experience. It's not the happiness after purchasing a brand new home. It's the letdown of having to pay more on that monthly payment and walking away.
Yeah. And one of the things we're working on in our insurance collaborative is an effort to help address that increased risk component that exists in the tail between where the government has to weigh in, which has become too often to be practical, and where the insurance company business model is, because it's no one's business model to insure against a firestorm destroying 9,000 properties in one location or a flood at 1,200 feet above sea level. We've really got to rethink how we're doing this. And the answer isn't to tell insurance companies, well, you just need to charge less, because, they can't make that work. They leave.
No, they can't be expected to lose money. They have to cover their costs and price and risk.
Yeah. Losing money is never a good business model, no matter how much volume you're doing. And you don't need AI to figure that out, but we can definitely jump into AI because there's a lot of things that it's figuring out. And, we're a small nonprofit and we have incorporated AI into expanding areas of our work. And I know that it's hard for me to actually meet or talk with a lender that isn't starting to use it in some ways. Tell me a little bit about how you're thinking about AI at Lennar Mortgage, and then more broadly, what the MBA is doing, because this just grows so fast and its impact expands so exponentially.
Yeah, we use AI in a lot of different ways, and it is evolving fast. We're using AI to support our people and help them become more efficient, right? At the basic level, we're using tools like Microsoft Copilot. Our frontline teams email borrowers every day. So we use AI to help them with tone. We help them with spelling, with clarity. It's really a small thing, but it makes a huge difference. Our people absolutely love it. We also use internal search tools powered by AI. So our teams can self-serve, find accurate answers really quick instead of waiting on an individual to respond, which is just going to research it anyway, right? We use AI in meetings. It helps us take notes and create action items automatically. It's really neat. And as we go deeper, we're leveraging bots and dashboards. And yeah, we name them Astro, Elroy, Judy. Sound familiar?
Mm-hmm. Oh, yeah.
They help with sending disclosures, with data validation, with task tracking, and flagging whatever it is that needs attention, as well as organizing data so the teams can work more efficiently. But the funny thing is that we've been using these tools before we even realized we were riding the AI wave. And now we're exploring agentic AI. It's a whole new level. So what's interesting is I thought AI would first show up in underwriting. I thought that was going to be the easy fix. But there's so much gray area, especially now with income analysis, gig economy, variable income, and how people are paid. We're actually seeing it's more opportunity on the front end, helping production teams, answering borrower questions, and supporting anything that's non-licensed task. So for us at Lennar, it's always been the theme, evolve or die. And AI is just the next step in evolving.
Yeah, and the large language learning model is so interesting to me because it's become so good at both understanding and talking and communicating in ways that were just unheard of before. And when you make a call to a call center, what you're dealing with is a person, they may or may not be in this country, English may or may not be their first language, and they have a manual, a big book that they're going to. When you ask a question, they're looking it up in that book or on computer now, and they're getting an answer, but there are hundreds or thousands of them. And if you're using AI, its ability to draw all the information you need is going to be even more accurate and sophisticated. And I think people are increasingly comfortable having these conversations. It's a little creepy at first, but it's you realize this is actually doing exactly what I need.
It's funny because I was talking to a group of loan officers. I'm constantly on the road, and I love to listen to loan officers. They're the front line, right?
Mm-hmm.
And I'm constantly asking. And one of the things I asked is, what about we're starting to record the different positions within our organization, one being loan officer. So I asked them, what do you feel about being recorded? 9 times out of 10, in the past, we heard, no, I don't want to be judged. I don't want to be recorded.
Mm-hmm.
Now we're hearing, Oh, but they record you on everything on big major companies, big banks. They all record you. What's the big deal? We are starting to evolve because every business, any industry are evolving towards AI. We can't be left behind.
No, absolutely. And we're going to need to really be thoughtful about how the government interacts with AI, because if we use the old-fashioned regulatory approach, I'm not saying we shouldn't have regulations, but if we use the old way of doing it, bad actors are always going to be way ahead of the government. We need to be really creative and use AI to come up with ways to keep it safe and not just assume that, the old way is going to serve us well in a really, 21st century and beyond technology.
Absolutely. You have to ensure the customer data stays protected. And it's a top priority for us. We're deliberate about not using any external AI platform. Everything we use is internal and contained, meaning the customer information stays within our secure system. For anyone out there looking to adopt AI, I can't stress it enough. You must use in-house tools only. Don't upload borrower data into public AI systems or tools that aren't designated for secure, compliant handling of sensitive data, because there's just way too much happening in our industry that they're going to potentially open up and offer to someone else.
Yeah. Well, it's expensive, but your ability to save money as you go is pretty incredible. I was in a meeting recently where Jamie Dimon, the CEO of JP Morgan Chase, was talking about their incorporation of AI, which has to be, closed off from external threats, and cost them $2 billion. They spent $2 billion on incorporating AI, but he said they saved $2 billion just in the time they were bringing it online. So by the time they had it fully integrated, they'd already saved the cost of putting it on.
Isn't that something?
Yeah. Not as many commas for most of us, but the principle was the same.
Yeah. Not as many commas. Agreed.
So tell me a little bit. You're president of the MBA now. How long does your term go?
I end October of this year.
Well, that's exciting because I know how hard that is. You must be on the road constantly.
Constantly.
And being the immediate past president, it probably isn't a heck of a lot better, but it's a huge commitment, and I certainly appreciate it.
Thank you.
I do this full time. This is my only job. And obviously I have a counterpart, Bob Brooksmith, who's pretty incredible at the, and he's been a guest here at the MBA. But, you do this work and you have a day job too, running a huge company. It always just kind of blows my mind how you guys do that.
Yeah, and at a time that our industry is pulling in every direction and needs our leadership more than ever. So it's definitely been a challenge, but I'll tell you, David, I have learned so much. I learned a lot about commercial that I was not involved in, but I have learned so much about MBA and the voice that we have in DC and the power that we yield. And this is our opportunity with this administration to strike while the iron's hot, let our voices be heard. So leadership and standing up proud from sea to shining sea across this country has been critical for me because it's so important right now.
Yeah. Well, that's awesome, and really appreciate you joining us. I always learn a lot. Today is no exception.
Thank you.
Thank you for listening to this edition of Beyond Four Walls. You can visit the National Housing Conference at nhc.org. There you can learn more about affordable housing policies, affordability challenges throughout the nation on our Paycheck to Paycheck database, and explore membership in NHC for you or your organization. We appreciate your interest and look forward to working with you in the future. Until next time, I'm David Dworkin, NHC's President and CEO, wishing you a great day.